Hi, I'm Dr. Alex Mosley, the founding editor of the Economics Circle, in my library as usual. Now, in this tutorial we're going to do a quick review of different currency regimes, looking at the difference between a fixed and a floating regime, looking at some of the implications, getting you used to how we look at currencies, and leaving you with some evaluative comments. The evaluative comments come from my angle, come from the way I look at economics and history, etc. It's up to you to work out which you think is the best. I give you one on the plate at the end, and you can say, no, I completely disagree with that, or yeah, I can see where you're coming from, I agree. It's up to you. This is what civilization's all about, putting our thoughts on the table, discussing and learning from each other. Okay, enjoy the tutorial. Thanks, guys. Bye. Right, as we've just said, currency regimes come either as fixed or as floating. And this is an either or. It's either fixed or it can be floating. Now, governments do intervene in floating regimes. We'll look at that a little bit later, but let's just get the basics sorted. So historically, currencies were generally fixed. They had different names around the world or around the major trading partners, and these names are often derived from the weight of gold or silver that they represented. However, in 1971, we're going to look at that a little bit later again, since 1971, the world's major currencies have floated against each other. That is, their value has been set by demand and supply by currency traders on the FOREX markets, particularly in London, New York, Tokyo, Singapore, a tiny bit, etc. But London, New York are the big ones. For some economists, the floating exchange rate has enabled a free market in currency values. For others, this has permitted governments to manipulate the money supply to avoid raising taxes or cutting expenditures. In other words, to cheat, as it were. Now, let's have a quick look at the fixed regimes. The gold standard, which operated between 1879 and 1934, taking out World War I, was an example of a fixed regime. The price of the dollar was fixed against that of the pound by the different weights each currency represented. So, in the gold system, if you had a £5 note, you could take it to the bank and get a certain amount of gold or silver with that note, because that's what it represented. And likewise in America, you could take your $10 note to the bank and get a certain amount of gold or silver, whatever it represented. Therefore, the ratios between the two currencies was absolutely fixed. Now, the fixed price is seen by supporters as something similar to the fixed ratio between inches and centimeters. This does not fluctuate and should not fluctuate. We don't hear on the news that the inch has depreciated against the centimeter for another day running on metric measurement trading systems. No, it's fixed. And for those of us, I'm a supporter of fixed exchange rates. For those of us that support it, we see it similar to the ratio between inches and centimeters, rather than something that fluctuates according to government policies, etc. Right? Beautiful picture there by Scott. Like that one. Now, here's a quick model of what a fixed exchange rate could look like. So we have the pound against the dollar at 280. This was its pre-World War II rate. And what we're seeing here is that the rate has to be guaranteed by the central bank. Central bank, where do they come from? Now, this is interesting because if you've got a central bank involved in the system, this creates the potential for political manipulation, or government failure, if you want to call it that, in the monetary system. If the banks were completely liberalised and free, and they worked at 100% reserve ratio, i.e. they didn't have any fractional reserves, see my other videos or other videos on the internet about that, then this wouldn't be an issue. However, if the pound is only printed by the central bank of the Bank of England, which has been in existence since 1693-4, I think it is, and has a monopoly over the issuance of currency in the country, then the central bank itself, rather than Lloyd's Bank or TSB or whoever in this country these days, Santander, the Spanish are taking over, etc., HSBC, Hong Kong, Shanghai Bank Corporation, whatever it is, these companies would print their own money. But if they're going through a central bank, then it's up to the central bank to print the national currency. Whoa, we have a problem here. So let's just follow this for a second. If the demand for the pound rose in forex markets to D-Pound 2 because, let's say, millions of tourists suddenly want to come to Britain to enjoy London in the rain and Cumbria, and we go up to Scotland for a fringe and things like that and pop into Wales. Right, if they wanted to do that, then the demand for the pound would increase on the markets. Accordingly, the central bank has to supply extra pounds, right, from its reserves. So it must hold a certain amount of reserves. The price against the dollar is not allowed to fall. Now, if British pounds are leaving the domestic market and heading abroad, this means domestic pounds circulating in the British economy dwindle, they diminish. Therefore, UK prices would fall across all the factors of production, right, and the retail markets, etc. There would be a deflationary effect, right, compensated to some extent by the foreigners bringing the pounds back, Now, if demand fell, on the other hand, then UK prices would rise. And this is one of the implications of the fixed exchange rate, that it's UK prices and factor prices, wages, rents, etc., that have to go up and down, not the currency exchange value, right? Now, here's the problem. If the central bank was engaged in an increase of money supply policy, then there's obviously going to be a downward pressure exerted on the value of the pound. However, the central bank has guaranteed the exchange rate, so it must simultaneously increase demand for the pound on the foreign exchange markets by selling its reserves. Whoa, hang on, let's go over that again. So it's printing money domestically, right, to keep the Union satisfied in the 1960s, or to pay for its huge current account deficits, or its huge public sector deficits, to pay them off cheaper with cheaper pounds, as it were. But it's guaranteed the exchange rate in the foreign exchange markets. So at the same time, it's having to buy those pounds back from foreigners or foreign holdings by diminishing its own reserves of gold, yuan, yen, euros, whatever, dollars around the world, right? Has to diminish its reserves. So maintaining a fixed exchange rate when you've got a central bank involved can be increasingly costly when it's expanding the money supply. Absolutely balmy policy. But when you read, say, Economics of Public Welfare by Benjamin Anderson, or if you look at the monetary history of the 20th century, this is what you often find, especially in so-called fixed rate regimes, which are dependent on central bank policy. You have central banks printing money on one hand and trying to maintain a fixed currency rate on the other hand. Strange. Now, the gold standard was abandoned in 1934 by governments as a sort of run-up to the Second World War, but because they'd fixed the exchange rate at the wrong price, and they were all engaged in monetary inflationism. It was resuscitated, hurrah, after the Second World War in the Bretton Woods system, which created a fixed currency system and used the US dollar as the world's reserve currency backed by gold. Sounded good? However, let's look at that again. The US dollar was the world's reserve currency, not gold was the world reserve currency as it was under the gold exchange, under the gold standard. It was now a paper currency was the world's reserve. And the Federal Reserve Bank has, and the Americans have had a terrible history of stabilizing their money. They tend to print it hand over fist. And not surprisingly, in the 50s and 60s, the Federal Reserve started printing the money a little bit at a time. There's the Korean War to pay for, then the Vietnam War, that was more costly. There was pressure in the late 60s on the US dollar as the reserve system, and then about 1969, early 70s, somewhere around there, so there's a YouTube video of this, if you look it up. President de Gaulle, parlant français, speaking French to an audience, and it's quite entertaining, because he says, look, money is gold, right? He says it in French. L'argent est or. Money is gold. It is not paper. And basically he was saying, quite strongly for a president, that what the Americans were doing, printing money, and France, within a few months after this speech, demanded its own gold reserves back from the United States. Says, you know that gold we sent to you during the Second World War for security? We'd like it back, s'il vous plaît. Maintenant. Now. And this put pressure on the dollar and the Federal Reserve system and its reserves of gold, because other countries, if the French wanted their gold back, then other people would want their gold, the Spanish, the British, and everybody else, right? And so in 1971, President Nixon said, we're taking the dollar off the gold standard. And that was the end of the Bretton Woods system, effectively, right? Now, since then, the major currencies have floated against one another. Rewind. Yes, President Nixon unilaterally, without Congress actually, took the dollar off gold and says, you know what, guys, we're just going to print this green stuff, and no, you can't have your gold back. That's basically the message. Incredible. Has the Fed been audited? Not recently. Now, so since then, the major currencies have floated against one another. Right. Floating regimes. If President Nixon took the dollar off, everybody else came off gold as well. And therefore, they floated against each other. And this was Milton Friedman argued for this because he thought, I don't know, maybe deep down he couldn't trust central banks with the money supply. Who knows? I haven't found that one out in his writings yet. Maybe somebody can leave a comment. It'd be very, very interesting to hear that. But the pound and the dollar and loads of other exchanges have floated against each other according to the demand and supply of the currency on the Forex markets. Now, there is a little variation of floating called dirty floating, dirty, or dirty dancing if you prefer it. Sounds much more romantic. When a government says that it will allow the foreign exchange to determine the day-to-day price of a currency. Seriously, we will allow you, but then periodically it intervenes to prop up some political cause or the notion of a fair price. Margaret Thatcher, this lady's not for turning, I'm the Iron Lady. Actually did turn on the currency. She allowed the pound to drop. And then round about 1985-ish, you can look it up on the currency charts, the pound was heading to parity against the dollar, i.e. £1 equals $1. Now, since it used to be about like $12 to a pound and $4 to a pound and $2.80, $2.30 to a pound, and this was rather embarrassing to the establishment of the British, and Margaret Thatcher demanded that the central bank intervene and start buying up the pound, for God's sake! Get it up! And the pound started almost touching the dollar and came up above it. Right, there are you can see this on some good foreign exchange currency trading charts, etc., where the pound was hitting the dollar just about, didn't go below, came up because the Bank of England went in, bought a load of pounds, and saved the day for the pound. Right, and we lost a lot of money doing this. Okay, yeah. Anyway. Now, speculators and traders usually catch on to government's interventions if there's some dirty floating going on. And they can potentially make good money, because a currency is being manipulated by the government and it's heading down, and they think, well, the government's going to pull it up any minute now, so I might as well go long on the pound or whatever. Or the pound's riding very, very high against the dollar and the government's moaning about exports, etc. So speculators start thinking, well, we'll take a bet on this and it's probably, we'll go short, and people can make a lot of money from this. Now, implications. In a fixed regime, such as the gold standard or the euro, looking across the euro markets, that's another tutorial, if a country is experiencing, say, falling productivity, its prices will rise relative to the rest of the world, right? Falling productivity, not producing as much, fewer goods, prices will go up, basic Econ 101 stuff. Now, demand, because prices are going up, demand from abroad will therefore fall. And assuming that it continues to import from abroad, the country will experience a fall in its gold reserves to pay for the shortfall, right? This is a trade account deficit on the visibles, or both visibles and invisibles. As gold leaves the market, domestic prices will be therefore falling, because remember, if you decrease the money supply in a country, domestic prices will start to fall, causing a relative deflation, which eventually can act to correct the economic imbalance created by the fall in productivity, because things are now cheaper. Now, this is what economists call an internal devaluation. It can still go on today when governments fix their exchange rate against another exchange rate or against gold or whatever, right? But it's also, arguably, this is always interesting, I like to compare international with national and say, what's the difference between the two, apart from political boundaries, passports, and so-called government international policies, right? If there is a town within a nation that experiences a drop in productivity, let's say in my own country, productivity in Birmingham, the second largest city in Great Britain, drops or suffers from rising costs because of high taxes or unions or whatever, investment and factors of production move out and prices and wages eventually fall, which will then attract entrepreneurs back into the city, right? So economic laxity, rising costs, deteriorating factor markets, intervention of government ineptitude cannot be hidden under a fixed exchange rate. So likewise within a country, if Birmingham's prices are going up right, now I'm allowed to do a Birmingham accent because I grew up near there. Now, therefore factors of production will be leaving Birmingham and nobody will want to go there. Eventually prices will start to drop because unemployment will be rising. It's where UB40 came from, right? Unemployment will be rising, and this will put downward pressure on wages, and finally the entrepreneurs will come back. That's an internal devaluation of Brummagem, right? It's the same for a national economy on a fixed exchange rate. The economy, or most of its markets, will have to adjust to regain competitiveness. But this is why many people don't like the fixed exchange rate or the euro, etc. It shows clearly what's going wrong. I wouldn't move to Birmingham if I were you, it's too expensive. And most people, politicians, economists of some sorts, prefer to avoid dealing with what is failing. I mean, think about it for yourself. When you know there's a problem with your grades or something, or you don't get a question or a concept, you just ignore it and hope it won't come up on the exam. Duh, it does come up. It's Murphy's Law or whatever. Now, let's have a look at implications for the ERM. This is the European exchange rate mechanism. Because after the abandonment of gold, European nations created an effort to reduce the swings that the floating regimes could create. So the Deutschmark franc would be going up and down like yo-yos. And this really started the track towards what became the euro. So they wanted to merge central banking policy. Now, stability was the key here. Because if currencies are bouncing all over the place, trade between the nations could be hindered and therefore be costly to the trading partners. And this required some effort and conversation between the central banks to ensure that, if one's raising interest rates, the other would follow suit, or decrease at the same time, or over time, etc. Right? So there had to be some cooperation between the European central banks, and this set the track for what became the European exchange rate mechanism, the ERM, and later the euro. Now, just imagine, just go back for a second to Econ 101. Traders are keen to reduce the cost of trading. Now, we've got a floating exchange rate system, and floating exchange rates tend to be very costly because the pound could suddenly shoot up, suddenly shoot down. Now, markets will create and have created plenty of insurance policies against currency swings, such as futures and options. You buy the pound a year from now or 6 months from now, or you buy an option that if the pound goes against you, you've got basically an insurance policy to pay up as the pound crashes. Like if you crash in a car, you've got an insurance policy. But these are expenses. They represent a higher cost of transacting across international borders that we don't have within a nation state. So if London's trading with Birmingham or with Edinburgh, there's no issue about the future value of the pound between the London pound versus the Birmingham pound. We just trade pounds, right? There may be gross effects with the pound, with what the Bank of England's doing to it, inflating it or deflating it or whatever. But we don't have to buy options with trading with people in Birmingham or Liverpool, or with Glasgow or anything. We just don't do that, right? So it's a cost that could be forgone. Now, places such as the City of London grew rich partly on the currency market trading and providing insurance policies for currency trades. Now remember, traders are keen to cut transaction costs. They just want to get on with exchanging product for product, product for service, service for service. So the market provides services to reduce the fluctuations on the currency markets. Now, arguably, what I'm hinting at here is that such services are only needed when state governments have entered the floating exchange rate systems that give them the so-called freedom over monetary policy, beware of that policy, to expand the money supply according to political needs. That is, again, to avoid having to deal with political or commercial ineptitude within the nation. That often happens, and the governments like to run to the central bank and go, print money, for God's sake, we're stuck. However, under a convergent regime like the ERM, such as the European nations were trying to pursue to try and converge on stable exchange rates, there's a problem that if national central banks pursue independent monetary policies, the entire system would be strained. So, for example, if the Banque de France pursued an inflationist policy relative to the rest of the countries in the tunnel of the ERM, the franc should fall. Its central bank, the Banque de France, would then be obliged to protect the franc from its own policies, basically, by buying it up on the markets or with other currency reserves. With other currency reserves or with gold. Now, this is, funnily enough, what happened to sterling. But let's just have a look at that again. That comment, the tunnel. This is a phrase used with the run-up to the ERM. That in the 1970s, the European central banks tried to create the metaphor was a snake in a tunnel. If you imagine a snake wiggling in the tunnel, it was allowed a plus or minus fluctuation against, so sterling was allowed a plus or minus against the franc or against the Deutschmark versus the franc or whatever. Now, if the snake was bashing its head against the top of the tunnel, you would then start selling that currency to get it down again. If it was bashing at the bottom of the tunnel trying to dig its way out, then you'd start buying it up. That's what the tunnel reference is for. So the snake in the tunnel. So not fixed, but converging regime. And this is where the euro comes out. Right now, this is basically what happened to sterling. Initially, during the late 70s and 80s, it was they started to shadow. So they started to shadow the German mark in 1988 with an eye to joining the ERM and later the euro. Right. That was always the vision from the European Union's point of view from a long time ago. But it was pursuing an inflationist central bank policy. Now, in 1990, I remember the day well, I was in the financial markets with a mutual fund company. It was very, very exciting. We got a lot of trade that day. And funnily enough, I won the prize for how much trade you could make that day. And my gift was a night out at the Savoy restaurant. I remember it very well. Took my flatmate. We had a great time. Got drunk on some lovely champagne. I think it was about £150 for the two of us to eat there. Fantastic. It was lovely. Ended walking back through the streets of London singing musicals. Great fun. I remember that day. Now, 1990, Britain joined the ERM. This sought to lock the currencies within a very narrow band of trading. But within 2 years, sterling came under a lot of pressure because it was following an inflationist central bank policy, and the pound fell against the Deutschmark, right? Let's have a look at that. Chancellor Lawson was encouraging a loose monetary policy, a bit more detail here, to sustain the late 80s boom, and the inflationism eventually caused the pound to fall. Now, famously, George Soros shorted the pound, which meant he believed it was going to go down. As it go down, he made money, and apparently netted $1 billion, according to legend. Now, speculators are often blamed for currency crises, but that's like football fans blaming the betting public for their team's loss. Duh. Now, currency crises occur when governments print money or permit an expansion of the banking system while simultaneously, as we've seen, trying to prop up the value of the currency relative to other currencies. It ain't going to work. The pound falls. Nice little animation I found there. Right. Being part of the ERM required monetary restraint on the part of the participating nations. If there was no restraint, then the entire system would be at risk. Now, this is true of any currency agreement around the world in which the nation states agree to an acceptable fluctuation between them. There has to be an inordinate, almost inhuman cooperation between central banks and politicians. That's going to be hard, isn't it? To agree to not follow an inflationist policy and maintain the small fluctuations permitted. This is why a fixed exchange rate is just hands down. You put a stamp on it and argument over. Any stupidity in domestic government policies or interventions, which is causing decreased productivity, is then borne out in domestic price changes, not using the cheat button by just printing money to get yourself out of the situation, right? Now, the euro, for those following, we need to know a little bit about the euro. It's the world's second largest currency. It's taken on the dollar. Huge currency. This was born from the desire to remove the risk of exchange rate fluctuations. Typical essay questions going on in the 90s and 2000s, the noughties, like, should Britain join the euro? Fors and against. Your evaluation, please. Yes, no, whatever you believed, right? Now, 11 countries initially joined the euro in 1999, with the notes circulating later in 2002. There were some administrative movements towards it, with using a euro type currency as an accounting system. As of 2015, the member states are Austria, Belgium, Cyprus, Estonia, Finland, France, 10 points, Germany, Greece, Ireland, Italy, Latvia, Lithuania, Luxembourg, Malta, the Netherlands, Portugal, Slovakia, Slovenia, and Spain. Not the United Kingdom, note, right? This is one of the big arguments in Britain. Should we join? Should we not join? But also, we've now got speculation in March, April 2015 as to whether Greece will remain a member. There's been an argument going back a few years as to whether Greece should have been allowed to join in the first place. and what's his name? Al Murray, the pub landlord comedian, who takes the mick out of us British very well by being ultra British. He's very, very funny, very witty, intelligent man. Does a great one on the Euro crisis, and I love his joke. He says, he asks an accountant, well, if I'm open up a bank account or something, would you do a credit check on me? Well, of course I would. Well, why the hell didn't they do it on Greece? They'd had a failed currency 3 times in the past 100 years or something, So Greece is now its party is looking at possibly pulling out of the euro, and that would have ramifications for the euro. We're going to look at that in another video. Right. So the implications for the floating regime is that its value is determined by demand and supply on the forex markets. Therefore, if a government increases the money supply, the value of the pound, or whatever it is, will fall. If the government decreases the money supply, then the value will rise. So let's have a quick peek at an inflationist policy to reduce the value of the currency. Take the pound dollar as 150. Now, holding demand constant, let's increase the supply of pounds to the forex markets, and the pound will go down from 150 to 130. Now, this is going to obviously reduce the value of the pound against the foreign exchange market, make British exports cheaper relative to those abroad. And this is often why governments are keen to do this. They love having their fingers on the inflationary button because it can reduce the exchange rate to encourage an increase in exports and make the country feel good, right? Feel good if it's exporting more to foreign countries. The problem is, as you should know from your economics, if we've just cheapened the currency, it's now more expensive to import. So some of us are going to suffer, including some of the companies that may be engaged in buying raw materials for manufacture and then selling abroad. So it's going to be perhaps a no-win situation for them. Now, if exchange rates are floating, governments can do this. Governments can cheat and just press go on the printing machines. This policy cannot occur in a fixed exchange rate regime, right? What we've seen with the fixed exchange regime, domestic prices must alter to regain competitiveness. It's the same with a city within a country or an area of a city within a country, right? Arguably, this is a bit deeper point for those that are doing some political philosophy as we're going along or want to know more about the history of economics, that really the floating exchange rate is almost, I would argue, an echo of mercantilism. Mercantilism is an old economic theory. It hasn't gone away. Economic theories tend not to go away, unlike in chemistry or physics where things are outcompeted by better theories of reality, because economics is about reality, it's about logic, etc., but governments can completely ignore it and go back to old-fashioned theories, right? Mercantilism is the argument that wealth can be raised through increasing exports or getting your hands on more money, which arguably is the main policy of the United States, in that it loves printing money. More money makes you richer, according to the Federal Reserve Bank, whatever words they use to describe that. But also you want to increase your exports and grab other people's resources like oil, right, while you're doing it, right? And if you've got to go to war for that, fine. I mean, that's what the British Empire was built on, wasn't it, in the 17th and 18th centuries, on mercantilism, right? Now, currency appreciation, the central bank could also use a deflationist policy to increase the value of a currency. Very rare, but to encourage, say, the purchase of imports. There may be raw materials that you want to buy cheaper, or to support a foreign central bank's inflationist policy. And I'm going to leave on this note, there's a little story here, just to finish off. We're looking at some macro issues here. So the central bank could support a foreign central bank's inflationist policy. What? To maintain a stable exchange rate. How bizarre. Right. Well, why would it do this? Well, if it's got some sort of tacit agreement, as the Swiss did with the European Central Bank, that the European Central Bank was on a bit of an inflationist thing to print money to support the Greeks, etc., and the Italians, the Spanish, the Portuguese, the pigs, P-I-G-S, nations of the European Union, the euro exchange rate mechanism. And the Swiss had some form of agreement with the European Central Bank to maintain almost parity. It was just a bit above 103 against the franc, or 1 franc would equal 103 euros, somewhere around there, 102, 103, right? And they supported this by spending their own reserves, right? So it would have to do this by basically buying up the other inflationary policy currency using gold and other currencies. So the Swiss central bank was supporting the euro to sustain this particular exchange rate. Then one day in January 2015, it decided to drop its support. This is what happened. The red candle shows the decline in about 15 minutes, I think it is. I can't remember what the candle hour, maybe an hour candle. But there it's going along. Oh, tickety boo. They're 1-2. They're 1 franc equals 120, is it? Perhaps 120, sorry. And then suddenly they decided, oh, we're not protecting it anymore. Didn't tell anybody else. No cooperation, no conversation. And suddenly, which annoyed the central bankers, of course, because they like a bit of conversation about it. So wham! It dropped effectively 30% before bouncing up to be about 20% down on the day and fluctuated after that. Like, my God! Knocked out a few brokerages, knocked out a lot of systems, etc. My currency trader mentor was caught in this a little bit. He'd gone long thinking it was going to go up. Don't know why. It'd been stable for ages. Maybe he's reading news, I'm not sure. But he was protected from his with his brokerage account, thankfully. He didn't lose as much as some people who, whoa, you lose your house on that one if you put a £10 a point down. That's a huge drop on currency trading. Wow. Now, so overall, let's have a look at fixed exchange rates versus floating. Now, with a fixed exchange rate, any economic problems must be worked through in the domestic economy. This creates an internal devaluation. With a floating rate, some problems can be ameliorated through currency depreciation. The government runs to the central bank. Can you print money, please? We're stuck. Now, arguably, this latter policy only postpones the inevitable day of reckoning. Can you feel these are evaluative comments you could use in an essay? You don't have to agree with me. You can argue the reverse. It's up to you. Now, so the latter postpones the inevitable day of reckoning, and in the meantime, civilians suffer inflationary pressures at home, and the finance markets may begin to reduce the country's credit rating. We can't trust you with currency anymore. A fixed exchange rate keeps the politicians in check, on the other hand. They tend not to like it, though, as it reduces their political power to make short-term impacts. That's a nice evaluative concluding comment. Again, you can take the opposing opinion. Do so should you see fit. It's up to you, but you've got to put your arguments and your analysis behind your evaluation if you're writing an essay on this. Okay, guys, thanks for listening. There's a lot in currencies and exchange rate systems, a lot of history to learn. There will be other tutorials put up on YouTube. Particularly, I'm quite keen to do the euro and also the exit should Greece or any currency come out of the euro, and what are those implications. Right, thanks for listening and have a good day. Cheers, guys. Bye now.